Number 1. Stocks versus EFTs. Most people think stocks and ETFs are the same. They're not. When you buy a stock, you're buying a small piece of one company, like Apple or Tesla. If that company performs well, your investment may grow. If it struggles, your investment can lose value. An ETF, on the other hand, is like a basket containing many different stocks. Instead of betting on one company, you're spreading your investment across dozens or even hundreds. Think of it this way. Buying a stock is like betting on one player, while buying an ETF is like betting on the entire team. So if you want higher potential returns and can accept more risk, stocks may suit you. If you want diversification and lower risk, ETFs are often the better choice. Which would you choose? Have you ever wondered what the difference is between trading and investing? Most people use these terms interchangeably, but they're actually very different. Trading is all about making profits from short-term price movements. A trader might buy a stock today and sell it tomorrow, next week, or even within a few hours. The goal is to take advantage of price changes. Investing, on the other hand, is a long-term strategy. Investors buy shares of good companies and hold them for years, believing those companies will grow over time. Instead of chasing quick profits, they're focused on building long-term wealth. Think of it this way. Traders try to time the market, while investors give the market time. Neither approach is automatically better. It depends on your goals, your risk tolerance, and how much time you can dedicate. So, are you a trader looking for quick opportunities or an investor building wealth for the future? Let me know in the comments. Growth stocks and value stocks sound similar, but investors buy them for completely different reasons. Growth stocks are companies expected to grow rapidly in the future. Investors pay more today because they believe earnings will increase significantly. Value stocks are companies that appear undervalued. Their share price is relatively low compared with what investors believe the business is actually worth. Think of it this way. Growth investors buy future potential, while value investors buy today's bargain. Which strategy fits your style? Have you ever heard people say index funds and mutual funds are the same thing? They're closely related, but they're not exactly the same. A mutual fund is a pool of money collected from many investors. A professional fund manager decides which stocks, bonds, or other assets to buy and sell in an attempt to meet the fund's objective. An index fund is a specific type of mutual fund, or sometimes an ETF that doesn't try to beat the market. Instead, it simply tracks a market index, such as the S&P 500, by holding the same or similar investments in that index. Think of it this way. A mutual fund has a driver choosing the route, while an index fund follows a fixed GPS route without trying to find shortcuts. Because index funds usually require less active management, they often have lower fees. Actively managed mutual funds may have higher fees because managers are researching and selecting investments. So the key difference is simple. All index funds follow an index, but not all mutual funds are index funds. Which one would you choose? Let me know in the comments. Bigger doesn't always mean better in investing. Large cap stocks are shares of very large, established companies. They tend to be more stable but usually grow more slowly. Small cap stocks belong to smaller companies. They can grow much faster, but they also carry higher risk. It's like comparing a giant oak tree to a young sapling. One is stable, the other has more room to grow. Would you choose stability or growth? Have you ever wondered why investors keep talking about bull markets and bear markets? They're not talking about animals. They're describing how the stock market is performing. A bull market is when stock prices are generally rising over a sustained period. Investors are optimistic, confidence is high, and more people are willing to buy because they expect prices to keep increasing. A bear market, on the other hand, is when stock prices are generally falling over a sustained period. Investors become cautious or pessimistic, and many start selling because they fear prices will drop even further. An easy way to remember it is this. A bull charges upward with its horns, while a bear swipes downward with its claws. Up means bull, down means bear. If you found this comparison helpful, don't forget to like, follow, and share this video, and let me know in the comments which topic I should compare next. See you in the next one.